$9 doesn't feel like much. It's a takeout coffee or a parking fee. It's the kind of money that slips through your fingers without a second thought. But what if that same $9, invested once a week using a strategy Warren Buffett has long supported, could potentially grow into thousands in monthly passive income over time? In this video, I'll walk you through exactly how it works. I'll show you how an average guy starting with zero can use just $9 a week to build a dividend portfolio that pays him every single month. I'll break down the automatic dividend reinvestment method that supercharges growth, show you the specific stocks behind this strategy, and in the end, I'll show you how that portfolio could turn a $9 weekly investment into a $500,000 portfolio that pays over $5,500 in monthly dividend income. Remember that this video explores a hypothetical long-term dividend scenario and is for educational purposes only. Results are not guaranteed, and all investing involves risk. Let's start with the basics, because if you're going to build your future on dividend investing, it needs to actually make sense. A dividend is simply your share of a company's profits. When you own stock in a business that pays dividends, that company sends you a portion of its earnings just for holding on to the shares. You don't have to sell anything. You don't have to trade or guess the next big stock. You just get paid for holding the stock. Now, some people invest hoping their stocks will go up in value so they can sell them at a higher price. That's called capital appreciation. And while that can be exciting, it's also unpredictable. You're relying on market timing, trends, and even luck. But dividend investing changes the game. Instead of hoping the market goes up, you build a portfolio designed to pay you no matter what the market's doing. And those payments can be used however you want. To reinvest, to pay bills, or eventually to fund your lifestyle. And here's where it gets really interesting. Many companies not only pay dividends, but actually increase them year after year. That's called dividend growth. It's this combination, consistency, predictability, and built-in raises that makes dividend investing so powerful. You're not just sitting on stocks hoping they go up. You're building a cash flow machine that becomes more generous as time goes on. This approach aligns perfectly with Warren Buffett's core belief. Own great businesses for the long run and let them do the work for you. Buffett doesn't obsess over stock charts. He buys companies he trusts to generate real profits year after year. And if they share those profits with him through dividends, even better. So now that you understand what dividends are and why they matter, let's look at how to make those dividends work harder through something called automatic dividend reinvestment. Here's the idea. When a company pays you a dividend, you could take that cash and spend it. A few bucks here and there, nothing wrong with that. But what if instead, those dividends were automatically used to buy more shares of that same company without you doing a thing? That's what automatic dividend reinvestment does. Every time you earn a dividend, it buys you more shares. And those new shares, they'll start paying dividends too. And those dividends buy more shares, and so on. Let's say you invest $1,000 into a stock that costs $10 per share. That gives you 100 shares. This stock pays a 5% annual dividend, which means you'll earn $50 in dividends during the first year. If you simply keep that $50 in cash, your investment doesn't grow. It just stays flat. But if you reinvest it, that $50 buys you 5 more shares, since each share still costs $10. Now you own 105 shares. In year 2, your dividends are no longer based on just 100 shares. They're based on 105. So you earn $52.50 in dividends. You reinvest that again, which gets you another 5.25 shares. You now have 110.25 shares. In year 3, those 110.25 shares earn you $55.13 in dividends. Reinvest that, and you're up to about 115.76 shares. And you didn't add a single extra dollar from your own pocket. Every year, your dividends are buying you more shares. And those new shares are earning dividends too. It's a self-reinforcing loop. One that grows faster the longer you let it run. That's how automatic dividend reinvestment works. And it's how small investments turn into serious income over time. This is the same concept Buffett has used for decades. Not just with stocks, with entire companies. He buys businesses that generate cash, and instead of pulling it out, he lets that cash fuel growth. That's compounding. And Buffett calls it the 8th wonder of the world. In fact, he once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So now that you see how strong automatic dividend reinvestment can be, the question is, what stocks are worth reinvesting into? Because not all dividend-paying stocks are created equal. Some pay high dividends but can't sustain them. Others grow too slowly to keep up with inflation, and some companies just don't have the financial strength to survive long enough to support your 30-year plan. That's where we apply what I call the Buffett filter. It's a simple checklist, but incredibly powerful. And yes, it's based on how I pick companies. Here's the first thing I look for: dividend yield. That's how much of a company's stock price they pay you each year. We want yields around 2% to 4%, not too low that it feels like a trickle, not too high that it signals trouble. Buffett's approach is to avoid extremes. He looks for solid, sustainable payouts. Next, we look at dividend growth, specifically how much the company has increased its dividend each year over the past decade. This is crucial, because a 3% yield today that grows at 15% a year becomes a monster in 20 years. It's like giving yourself a raise every single year, automatically. Then we consider share price appreciation. While we're focused on dividends, a company whose stock grows in value over time adds fuel to your portfolio. Because when you reinvest dividends, you're buying into an asset that's growing in both income and value. But Buffett wouldn't stop at the numbers. He always digs into the business itself. So our next filter is business quality. That means a strong competitive moat, consistent profitability, long-term relevance, and a simple model that makes money in good times and bad. If a company can't explain how it makes money in one sentence, Buffett's probably not interested. He likes businesses that are easy to understand and hard to compete with. And finally, we look at diversification. You don't want all 5 of your picks to come from the same industry. The key is balance. One company for reliability, one for growth, one for protection. That way, even if one has a bad year, the others carry the load. Now, using this exact filter, I built a 5-stock portfolio that checks every box. And in the end, I'll show you how a portfolio of those stocks can turn a $9 weekly investment into a $500,000 portfolio that pays over $5,500 in monthly dividend income. Let's break them down. The first one on my list is Schwab US Dividend Equity ETF, SCHD. This is our foundation. SCHD holds a basket of high-quality US dividend-paying companies. It's like buying a carefully selected portfolio in one pick. It currently yields 3.74%, with a 10-year dividend growth rate of 10.77%, and it's delivered an average annual share price appreciation of 8.01%. Buffett loves low-cost index-style funds for their consistency and simplicity, and SCHD fits that mold. Next, I have Morgan Stanley MS. This pick represents the financial sector. It pays a 2.81% dividend yield, and the impressive part is its 23.45% dividend growth over the past decade. On top of that, its share price has appreciated 13.46% per year. With a strong brand, diversified revenue streams, and shareholder-friendly practices, this is an easy-to-understand and well-managed stock. Then I have Abbvie ABBV, a pharmaceutical giant that brings stability and reliable cash flow. It currently yields 3.44%, with a 12.86% dividend growth rate and 10.65% average price appreciation. As Buffett often says, he prefers businesses with pricing power and repeatable products, and healthcare fits that bill. AbbVie's combination of blockbuster drugs and reinvestment discipline makes it a solid Buffett-aligned pick. At number 4, I have NetEase, NTES. This is our growth engine. NetEase is a Chinese tech and entertainment company with a global footprint. It has a 1.97% dividend yield, but a massive 24.79% dividend growth rate and 17.17% share appreciation annually. It adds international diversification and strong long-term upside. And finally, a real estate investment trust, REIT, with a defensive edge. And for this, I have Extra Space Storage, EXR. People always need storage, whether they're moving, downsizing, or running small businesses. EXR pays a 4.29% dividend, has grown those dividends at 12.47% annually, and delivered 7.78% price growth. Next step is to calculate your portfolio metrics, and it's pretty simple. To calculate the portfolio averages, you simply take the individual values from each stock and find the average. Let's start with the dividend yield. You list the current yield for each of the 5 stocks. SCHD at 3.74%, Morgan Stanley at 2.81%, Abbvie at 3.44%, NetEase at 1.97%, and Extra Space Storage at 4.29%. Add them all together. That gives you a total of 16.25%. Then divide that by 5, since you have 5 stocks, and you get a portfolio average dividend yield of 3.25%. You can follow the exact same process to calculate the average dividend growth rate, which for this portfolio comes out to 16.87%. Finally, do the same for annual share price appreciation, and for this portfolio, that is 11.41%. Now let's bring it all together. You've got the strategy. You've got the portfolio. You've got automatic dividend reinvestment. Now let's look at what happens when you, starting with nothing, commit just $9 a week to this exact portfolio. At the end of year 1, your $9 weekly investment would add up to $468. Fast forward 10 years, and the portfolio would be valued at $9,937. By year 20, it would reach $65,911. Give it 10 more years, and by year 30, your portfolio has the potential to reach $558,706. That's more than $500,000, built from $9 at a time. And it's not only portfolio valuation, there's income too. By year 30, this portfolio has the potential to pay $66,962 per year in dividends. That's $5,580 per month. All in all, NTES portfolio will have added $544,666 to your investment, out of which $283,636 came purely from reinvested dividends and $261,030 from capital appreciation. Want to know what smart money is doing with their cash right now? Click the video on your screen.